Hello everyone, welcome to the 65th episode of me learning how to trade in Forex. So in the last video we went through how to use a stochastic indicator, basically having the two lines. Above 80, below 20 is when it's overbought or oversold. But the stochastics can remain above 80 or below 20 for really long periods of time, so don't just buy straight away when you see it's above 20 or below A. When you buy straight away when it's above 20, or sell when it's below 80, I think. We buy when it oversold. Oh no, when you sell when it's above 80 and buy when it's below 20. There we go. So yeah, don't be a stochastic sheep. And now we are currently doing how to use the relative strength index. So let's get started. How to use RSI, or the relative strength index. 05, 03, 2024. Relative Strength Index, or RSI, is a popular indicator developed by a technical analyst named J. Wells Wilder that helps traders evaluate the strength of the current market. Relative Strength Index is a technical indicator used to evaluate the strength of the current market. RSI is similar to stochastic in that it identifies overbought and oversold conditions in the market. Relative strength index identifies overbought and oversold conditions in the market. It is also scaled from 0 to 100. Also scaled from 0 to 100. Typically, readings of 30 or lower indicate oversold market conditions and an increase in the possibility of price strengthening. Readings of 30 or lower indicate oversold market conditions and an increase in the possibility of price strengthening, which is going up. Some traders interpret that an oversold currency pair is an indication that the falling trend is likely to reverse, which means there's an opportunity to buy. Some traders interpret that an oversold currency pair is an indication that the falling trend is likely to reverse, so it's an opportunity to buy. Readings of 70 or higher indicate overbought market conditions and an increase in the possibility of price weakening or going down. Some traders interpret that an overbought currency pair is an indication that the rising trend is likely to reverse, so it's an opportunity to sell. Um, some traders think that the rising trend like the reverse, which is the opportunity to sell. Okay, good. Relative strength index, RSI, overbought, oversold. So when it's overbought, you need to sell, right? Sell here, and when it's oversold, you need to buy. So apparently, it's going to go up from here then. In addition to the overbought and oversold indicators mentioned above, traders who use a relative strength index indicator also look for center line crossovers. Center line crossovers are also looked at. A movement from below the center line 50 to above indicates a rising trend. So below center lines like here, below to here. Movement from below the center line 50 to above indicates a rising trend. So you should buy here, right, shouldn't you? A rising center line crossover. A rising center line crossover occurs when the relative strength index value crosses above the 50 line on the scale, moving towards the 70 line. Moving towards the 70 line. This indicates the market trend is increasing in strength. This indicates the market is increasing in strength and is seen as a bullish signal until the RSI approaches the 70 line. It's seen as a bullish signal until the relative strength index crosses the 70 line. Movement from above the center line 50 to below indicates a what's the opposite? Rise, falling trend. A falling centerline crossover occurs when the relative strength index value crosses below the 50 line on the scale, moving towards the 30 line. This indicates the market is decreasing in strength. It's seen as a bearish signal until the relative strength index crosses the 30 line. Below the 50 on the scale, moving toward this is weakening in strength. And is seen as a bearish signal until the RSI approaches the 30 line. Yep. How to trade using the relative strength index. RSI can be used just like the stochastic indicator. We can use it to pick potential tops and bottoms depending on whether the market is overbought or oversold. Below is a 4-hour chart of the Euro USD. Okay, Euro USD has been dropping the week, falling about 400 pips over the course of 2 weeks. On June the 7th, yeah, I don't know what. It is already falling below the 1.2 handle. However, RSI dropped below 30, signaling that there might be no more sellers left in the market and that the move could be over. Price then reversed and headed back up over the next couple of weeks. Right, okay. It's already trading below the 1.2. So 1.20, I think. However, RSI dropped below 30, this is 30, signaling there might be no more sellers left in the market and that the move could be over. Price then reversed and headed back up to the next couple of weeks, over the next couple of weeks. So if it's oversold, an increase in the possibility of price strengthening. So it's an opportunity to buy. So if you bought here, then the price would have gone up. Determining the trend using the RSI. RSI is a very popular tool because it can also be used to confirm trend formations. Relative strength index can also be used to confirm trend formations. If you think a trend is forming, take a quick look at the RSI and look at whether it is above or below 50. If you're looking at the possible uptrend, then make sure the RSI is above 50. If you're looking at a possible downtrend, then make sure the RSI is below 50. Possible uptrends. For possible uptrends, make sure the relative strength index is above 50. For possible downtrends, make sure the relative strength index is below 50. So RSI crosses 50 here, and the price continues to fall down. Because it's below 50. At the beginning of the chart above, we can see that a possible downtrend is forming. To avoid fakeouts, we can wait for the RSI to cross below 50 to confirm our trends. Sure enough, as RSI passes below 50, it is a good confirmation that downtrend is actually formed. Okay. Next one. How to use Williams percentage R, Williams percentage range. How to use Williams percentage R, Williams percentage range. The Williams percentage range, also called Williams percentage R, is a momentum indicator that shows you where the last closing price is relative to the highest and lowest prices of a given time period. It's a momentum indicator. Um, 05, 03, 20. Did I write the date? Oh, I did. Williams percentage range is a momentum indicator which shows you where the last closing price is relative to the highest and lowest prices of a given time period. So it's like a ratio then, basically. As an oscillator, Williams percentage R tells you when a currency pair might be overbought or oversold. Williams percentage range tells you when a currency pair might be overbought or oversold. Think of it as a less popular and more sensitive version of a stochastic. As a momentum indicator, it also gives RSI relative strength index like vibes in that it measures the strength of the current trend. Williams percentage range measures the strength of a current trend. But whilst the RSI uses its midpoint figure 50 to determine trend strength, traders use percentage as extreme values, minus 20 and 80 for Qs. How to trade Forex using the Williams percentage R indicator. Did you know that stochastic and percentage R uses the same formula to pinpoint the relative location of a currency pair? The only difference is that stochastic shows you a relative location by using the lowest price in the time range, whilst percentage R uses the highest price to pinpoint the closing price's position. In fact, if you invert the percentage R line, it will have the exact same line as the stochastic percentage K line. This is why Williams percentage R uses the 0 to 100 minus 100 scale, whilst the stochastic is scaled from 0 to 100. Williams percentage range uses 0 to minus 100. A reading above minus 20 is overbought. A reading below minus 80 is oversold. Wait, a reading above minus 20, so that's like minus 19 to like minus 19 to minus 100. Minus 19 to minus 100. No, above minus 18 to 0. Yeah, minus 18, no, minus 19 to 0, Jesus. Below 80, minus 80, that's minus 81 to 100, minus 100. An overbought or oversold reading does not guarantee that price will reverse. Overbought or oversold reading does not guarantee that the price will reverse. All overbought means the price is near the highs of its recent range. All oversold means oversold just means the price is near the highs of its recent range. Wait, this is overbought, not oversold. Oversold just means the price is near the lows of its recent range. Wait, so overbought. So if it's overbought, then that means loads of people are trying to buy it, but that's not enough for it to go around. So the price is near the highs of its recent range. So the range is its biggest minus the smallest value. Because it's overbought, there's more demand than the supply, so the price is going to raise, so it's going to be near the highs of its recent range. The same goes for oversold. If it's oversold, what does oversold mean though? Oversold, that means overbought means there's too many people buying it, but that's not enough for it to go around. Oversold means too many people selling it, and there's not enough for it to go around. So the supply is the demand is more than the supply, or the supply is less than the, the demand is, the supply oversold. So lots of it has been sold out, So the demand is very high, but the supply is very low. If the demand is very high and the supply is very low, then the price is going to go up again. Wait, when they say oversold, does that mean there's too much of it and not available to be sold? Because then that would make sense, because if there's too much of it and not enough demand, then the price drops, so the price is near the low of its recent range. Okay, that's confusing then. Yeah. Oh, there's nothing about overbought or oversold. It's a bit too late to explain what overbought or oversold means, isn't it? But I guess it kind of makes sense on its own. Oh, well, overbought does, but oversold? What the hell is oversold? Ah, we'll move on from this. Determining the trend strength using percentage R. Williams percentage R sensitivity to volatile prices comes in handy when you want to know if prices are maintaining their bullish or bearish momentum. In Euro USD's daily chart below, you can see that the pair tried to extend its uptrend but failed to reach a new price and percentage R highs. This means that prices aren't hitting the high end of their range as quickly as they did before, and that the bullish momentum might be running out of steam. In this case, the pair ended up dropping 200 pips in a week. Almost immediately after that, the price gained enough bullish momentum to push percentage R above its oversold levels. But although Euro USD is still popping up red candlesticks, they're not enough to drag Williams percentage R back to its previous lows. Another loss of momentum, Williams percentage R thought so. Turns out, the bulls did take over and push Euro USD around 775 pips higher in less than 30 days. Now that's a good oscillation right there. No wonder superfans call Williams percentage R as the ultimate oscillator. Wait a second. You can see that a pair tried to extend its uptrend, but failed to reach a new price and percentage R highs. Wait, that's this bit here, isn't it? Pair tried to extend its uptrend, so like this bit here, but failed to reach a new price percentage R highs. Percentage R highs. A reading above -20 is overbought. Well, it's not exactly helpful when there's no scales on here. Below 80. I'm guessing that's -20, right? That's -80. Because it's overbought. Yeah, that's overbought. So, this means pair but failed to reach a new price percentage R highs, so that's that bit here. And bullish momentum might be running out of steam. In this case, the pair end up dropping 200 pips a week, so that's that bit here. Almost immediately after that, the price gained enough momentum to push percentage R above its oversold level, so that's that bit there. No, above its oversold levels. So like here. No, it's here. But although Euro USD is still popping up red candlesticks, so that's that bit here, they're not enough to drag Williams percentage R back to its previous lows. Another loss of momentum, Williams R thought so. Turns out the bulls did take over and push EURUSD up around 775 pips higher in less than 30 days. So all I'm getting from this graph is that because it hit here and it's below the minus 80, it's oversold. So if it's oversold, let me see. Then it's an opportunity to buy because the prices will increase, and it does. So it increases. It goes to here. It's above the minus 20. If it's above the minus 20, then it's overbought. So if it's overbought, then it's time to sell, and well, the price does drop. So it hits here, and now it drops below the minus 80. So if it's minus 80, now it's oversold again, which means it's time for you to buy, because it is oversold, and when you do buy, the price shoots off to the sky. So, and it does, yeah. So that's what I think happened. I don't really understand what they were talking about here, to be honest. So, okay, next one. How to use ADX, average directional index. How to use ADX, average directional index. When trading, it can be helpful to gauge the strength of a trend regardless of its direction, so whether it's bullish or bearish. And when it comes to evaluating the strength of a trend, the average directional index is a popular technical indicator for this purpose. Average directional index is a technical indicator for evaluating the strength of a trend. The average directional index, or ADX for short, is another example of an oscillator. ADX fluctuates from 0 to 100. A average directional index uses 0 to 100, with readings below 20 signaling a weak trend. Readings below 20 shows a weak trend. Readings above 50 shows a strong trend. So not above 80 then. Okay. The ADX calculation can be complicated, but in a nutshell, the stronger the trend, the higher the ADX goes. The stronger the trend, the higher the ADX goes. The stronger the trend, the higher the average directional index. When an average directional index is low, it highlights periods when the price is usually going sideways or trading in range. Lower average directional index shows periods when the price is usually going sideways or trading in range. When the ADX has risen above 50, this indicates that the price has picked up momentum in one direction. Strong trend. Indicating the price has picked up momentum in one direction. So whether that's bullish or bearish, it does not know or care. Unlike stochastic, ADX does not determine whether the trend is bullish or bearish. Yep. So ADX does not determine whether the trend is bullish or bearish. Rather, it merely measures the strength of the current trend. Average directional index only measures the strength of a trend. Of the current trends of because of that, ADX is typically used to identify whether the market is ranging or starting a new trend. So average directional index is typically used to identify whether the market is ranging or starting a new trend. ADX is considered a non-directional indicator. It is based on comparing the highs and lows of the bars and does not use the close of a bar. The stronger the trend, the larger the reading, regardless whether it's an uptrend or downtrend. Yep. Regardless of the direction. Regardless of the trend direction. How to use ADX. When you're using the ADX indicator, keep an eye on the 20 and 40 as key levels. Here's a little cheat sheet to help you interpret ADX values. So ADX value rising, indication strengthening trend, falling, weakening trend, below 20, weak trend, between 20 and 40, strong trend, above 40, extreme trend. Take a look at these neat charts we've pulled up. Okay. In the first example, ADX lingered below 20 from late September until early December. So this is below 20 here. So it's stuck in a range because it's below 20. So it's a weak trend. As you can see from the chart, Euro CHF was stuck inside a range during that time. Beginning January though, ADX started to climb above 50. Signaling that a strong trend could be waiting in the wings, but whether that's an uptrend or downtrend, we do not know. And would you look at that, Euro CHF broke below the bottom of the range and went on a strong downtrend. Oh, that would be around 400 pips in the bag. So we can see the rise happening here. There's the ADX 50. Extreme trend, as they called it, extreme trend. So very obvious. But is this a lagging indicator as well? So because if you line the graph up, right, that bit there should be like a I guess strength isn't about like the gradient of the trend, is it? Because that bit there, it doesn't really tell you much. It's only at this bit here you would notice, but by then you've missed out on half of the trend already. So I don't know. Book it, baby. Now let's look at the next example. ADX is less than 20, so ho-hum ranging. Yep, so there's nothing much happening here. And ADX goes above 50 here. Boom, uptrend. So it goes here. Yeah, so you see this bit here, it starts shooting up, and you know that because it lines up with this bit here, which is also trending upwards. So I think to determine the direction of the trend, you probably need to look at the candlesticks themselves, because this one is a bit red. Oh, well, they're all red. So I think red candlesticks means a bearish trend, so that means it's going to go down. Green sticks are bullish candlesticks, so it's going to go up. Hence the upward trend. Just like in our first example, ADX hovered below 20 for quite a while. At that time, Euro CHF was also arranging. Yep. Soon enough, ADX rose above 50 and Euro CHF broke above the top of its range. Ta-da! A strong uptrend took place. That'd be 300 pips, signed, sealed and delivered. Looks simple enough, right? If there's one problem with using ADX, it's that it doesn't tell exactly whether it's a buy or sell. What it does tell you is whether it would be okay to jump in an ongoing trend or not. Average directional index doesn't inform you of buy or sell. Once average directional index starts dropping below 50 again, it could mean that the uptrend or downtrend is starting to weaken and that it might be a good time to lock in profits. How to trade using ADX. One way to trade using ADX is to wait for breakouts first before deciding to go long or short. Wait for breakouts first before going long or short when trading with the average directional index. ADX can be used as a confirmation whether the pair could possibly continue in its current trend or not. Average directional index could be used as a confirmation to whether the pair could possibly continue its current trend or not. Another way is to combine ADX with another indicator, particularly one that identifies whether the pair is headed downwards or upwards. Yep. Pair average directional index with an indicator which identifies whether the currency pair is bearish or bullish. ADX can also be used to determine when one should close a trade early. Average directional index could also be used to determine when to close a trade by looking at its value. For instance, when ADX starts to slide below 50, it indicates that current trend is losing steam, i.e. when it starts to go below 50, it indicates that the current trend is losing steam. From then on, the pair could possibly move sideways, so you might want to lock in those pips before that happens. As the saying goes, the trend is your friend until it stabs you in the back. Trend, you. Stab you in the back with a knife. Oh wait, I mean until it reverses. Wait, what? Got caught up in memories for a moment there. The next time you think a trend is changing and you need to decide whether to stick to this friend or cut ties, consider trying the ADX to confirm the trend strength. Let's add this in. Okay, that's pretty good. Consider trying the ADX, the average directional index, and confirm the trend strength. Yep. I am going to leave this episode here. Thank you guys for watching. In the next video, we're going to go through the Ichimoku Kinko Hyo, if I've pronounced that right. So, yeah, and I'll see you then. Peace.